Hi there and welcome. My name is Quint, and because this video is going out to a variety of places and being used in a variety of settings, let me go ahead and make a brief introduction for those who do not know me. I am an adjunct professor here at the University of Kentucky, teaching a few courses in finance. I'm also the founder and principal advisor of Jewel Financial, a fiduciary fee-only investment advisory firm here in Central Kentucky, servicing clients all over the United States, managing over $250 million in discretionary assets. Today, we are going to be talking about risk. This is one of the areas that I really feel is not talked about and educated about enough, not even close. When people talk about risk, it is almost in a fear tactic mentality, and it can be perceived as very negative. Now, if it's not handled appropriately, it certainly can be very negative. But we spend a lot of time discussing risk in an academic setting, but many people in the investment world, they don't have an academic finance background, and so they've never discussed this. So I thought it would be very appropriate to take a deep dive into the world of risk from an academic perspective to help you as you venture into your own investment world. This is a very, very important subject matter, and we're going to dive in. And if you are a student, perfect. We talk about this a lot. These are areas you will be familiar with, and hopefully I can shed some practical light on this environment. If you're not a student of mine and you're just kind of taking a glimpse into this world, welcome to the classroom and welcome to the academic world of risk. Now, it's very important to define risk. We all have a general definition of risk and what risk is. Webster's dictionary defines risk as a possibility of loss or injury, peril. The chance of an investment, such as a stock or commodity, to lose value. That is what we would consider risk in the investment world. Well, I have a basic definition. It's very simple. The risk is losing money. Nobody wants to lose money. Now, there's an old adage, in order to have some sort of reward, you have to take some risk. The question is how much, and can we actually quantify risk? That's what we're going to talk about today. But before we do that, why would we even take risk? Why would we even put our capital, our hard-earned dollars, at risk of losing money? Many people lose sight of the fact that the number one reason that we invest or should invest is to try and uphold the purchasing power of your dollars. We're in an environment right now where the buzzword is inflation. If you haven't heard that word mentioned countless times over the last several months, you've been living under a rock. Obviously, it's 2021. This is a very, very hot topic. We are seeing inflation numbers that we haven't seen in this country in 30, 40 years. It's very concerning. Why is it concerning? Because as the prices of goods and service increase, it takes more money to purchase those same goods and services. Now, if you're old enough to remember the 70s, the last time we had real, true inflation in this country that lasted longer than a quarter or two, the purchasing power of the dollar diminished considerably as we saw prices rise over that decade, cumulatively around 100%. The concern I have in the United States is with so many people living on a fixed income, living, many of them paycheck to paycheck, what happens when the food, the utilities, the services they use every day double in price? That's a possibility, a real possibility. Will they still be able to pay that mortgage? Will they still be able to pay the rent? I'm not sure. But if we are an investor, one of the reasons, the primary reason in my opinion, that we invest is to keep up with purchasing power. Now, how does that happen and why does that happen? Why would we put our assets at risk to try and keep up with purchasing power? Well, the companies that we use every day, they are going to be passing those rising prices along to consumers. It's just going to happen. That's why we're paying more at the grocery store. That's why paying more at the utility companies, etc. They're going to pass that along to us. As they pass that along to us, those profit numbers actually begin to increase, and those companies should continue to do very well over time. Now, there's a breaking point. I know many of you out there going, Quint, yeah, but if it lasts too long, we have problems. And you're right. There is a breaking point, because if it rises too fast, too quickly, people will change their purchasing habits. They will no longer spend the money that they have been spending, and those companies will suffer. But that's not what I'm talking about. What I'm talking about is consistent standard inflation over time. That's why we invest. If we take a look at the screen, for instance, what we're looking at here is a very interesting chart that shows the erosion of purchasing power over the last 100 years. If you can see, I know it's hard to see, but if you can see what a dollar bought in 1913, a dollar bought in 1913 30 Hershey's chocolate bars. Today that would be $26.14. And in fact, I haven't bought a Hershey bar under $1, so I don't know where they got that price. It'd be more like $30. In 1929, a dollar bought 10 rolls of toilet paper. In 1933, $1 bought 10 bottles of beer. 1944, 20 bottles of Coca-Cola. Let's move all the way to 2020. What does a dollar buy today? 1 McDonald's coffee. What are we showing here? We're showing the erosion of purchasing power of the dollars over a period of time, sometimes with rapider descent due to higher than anticipated inflation, but over time a standard consistent decline in purchasing power. So again, why do we invest our dollars instead of keeping them in cash, free of all risk? We do invest so that that dollar will keep up with the purchasing power that we need in order to continue to buy the goods and services that we buy every day. Now, how then do we monitor or temper the risk that we expose ourselves in, let's say, our investment portfolio? These are the standard methodologies by which people approach risk and allocations within their investment portfolio. Number one, and this is the most popular, we would call this age-based allocation. This will look at how old a person is and determine how much exposure or risk they can handle. I always hear the comment, well, we're retired, we don't have time to make it back. We can't afford to lose it. Next to no allocation decision, this might be the worst allocation decision. And you're going, what? Quint, that makes no sense. Well, it's an ingredient. It's a component. It's one of the variables that should be taken into consideration. But if it's the only one, you risk running into significant problems. Let me explain. Let's assume someone retires at the age of 65 in the United States. that individual, man or woman, has a life expectancy approximately to 88 years of age. If you are a couple, there is a 50-50% chance that one of you will live to the age of 90. 90. What does that mean? Many people think that when they are retired, their risk should be over. They're done. Unfortunately, you are entering a 25-year period of purchasing power erosion. What does that mean? That means your investment time horizon is not the day you turn 65. It is actually your life expectancy. So while many people make the classic mistake of assuming, hey, once I'm retired, risk is off the table, they're going to be facing the rude awakening of a significant decline in purchasing power due to a significant rise in inflation over time. In America, the CPI, which is the Consumer Price Index, which typically measures inflation, over the last 80 years has been approximately 2.4% per year. We are seeing a significant increase right now. That actually is on par to be around 5% right now, but we do not believe that will remain. We do believe there will be periods of higher than expected inflation, but over time, we feel comfortable with approximately a 3% rate. But that means that every single year, your purchasing power is declining by 3%. Medical expenses, on the other hand, the number one expense to a retiree, has averaged around 6% per year. So again, while many people take the first approach, which we would call age-based allocations, it unfortunately sets them up for a significant issue if their age-based allocation only correlates with their retirement date. How about the next one? Goals. This is better. This is better in that it takes into consideration things that you're trying to accomplish with your money, such as not running out of money, obviously. How about lifestyle? What it is that you like to spend during retirement? What are you trying to achieve? If you're younger, are you trying to invest for a person's college, another generation's first home? Are you trying to invest so that you can ultimately have a second home maybe, or just retire in a comfortable lifestyle, not running out of money? This is a key component to consider when you are aligning your overall allocation and taking risk. How about the third? Very often never discussed, except within our walls. In my opinion, it's the number one factor in risk or allocation, and that is your individual temperament. This is the psychology of money. It is how you feel about the markets and movement and risk. And I have a news flash for you. Often, number one and number three have zero correlation. I know 40-year-olds who have a risk tolerance of someone who should be in their 80s. They are petrified of the markets. They are petrified of stocks. And you know what? That's okay. It just has to be taken into consideration. You can't often change that. It takes a long time. It takes a significant amount of education and experience in order to change that behavior. You can't all of a sudden one day wake up and go, you know what? I'm okay with the markets. I'm okay with the volatility in the markets. I know 80-year-olds who have point blank told me, clients of mine, Quint, I never want to own a bond. Do not ever buy me a bond. And the reason is they've been investing for 60 years. They know that long term, the equity markets have been the best performing asset class. They handle the volatility. They don't care. They're knowing full well they're invested for dividends, long-term appreciation, etc. They've been through the ups and downs, and they have full faith and confidence in my ability or our firm's ability to manage through that. So they don't want to own a bond. Everyone is different. I call this the sleeping risk level. Again, not the only component, but certainly one to take into consideration. If you're not looking at all three of these, if you're not looking at your goals and how you should be allocated to achieve those objectives, or your temperament, are you getting concerned when you have a 2 to 3 to 4% market pullback and you're freaking out thinking the end is near? Are you watching your account every single day, that sort of thing? Or are you just saying, you know what, when I'm 65, I'm all cash, I don't even worry about it, and then you're going to find yourself running out of money by 72. These are all things to take into consideration. But what's very important is to understand the education behind risk and the expectations. And that's where we're going to dive into the classroom and we're going to go today. And so I want you to put on the old thinking cap. You don't have to take a lot of notes. You can go back and watch this again. But we are going to talk about a term that is thrown around in the academic walls regarding finance. And often, many of you, especially you students, you leave these walls. I did it too, and you never think about it again. But in my opinion, it is the most important term in investing ever. It's called standard deviation. Standard deviation. And I have for you the formula for all of you math aficionados out there, the formula used to calculate standard deviation. Now, what is standard deviation? Well, I'm glad you asked. The actual academic definition of a standard deviation is a statistic, now we're going into statistics, that measures the dispersion of a data set relative to its mean. So let's break this down. It measures the dispersion, so where data falls relative or in relation to its average. Okay? I'm going to explain it so you understand it in just a second. You know what my definition of it is? It measures movement around an average. Movement around an average. And we can use this in a variety of areas. It's universal. It's math and statistics. It can be used in investments. It can be used in weather, which we'll talk about in just a second. In fact, let's run an example. Now, what you're looking at here is a bell curve of events that have occurred over time. So if you were to measure events that happened, in this particular instance, we are going to measure weather in the state of Kentucky. And so we look back every day over the last several years, and we look at all of the degrees, the temperature gauge of weather in the state of Kentucky, and we write it down. Today, it's unusually warm, unseasonably warm in October. It's 78 degrees or something out there. So October 12th or 13th or whatever today is, well, it's 78 degrees. Well, yesterday it was 81, and the day before that it was 82. And we're just using the average. You could go as deep into this as you wanted. You could go, well, at 6 a.m. it was 60 degrees, or at 2 p.m. But let's just take the average for the day, 75. And yesterday it was 81. And now it's January, and it's 22 degrees, and it's 17 degrees. And so we have a few over here that are much cooler than normal. And every once in a while, because we're in Kentucky, we have a day where, holy cow, it was ridiculously cold in the middle of January, just unseasonably cold, colder than we've ever had. And then 3 days later, oh my goodness, it's warm again. Okay, you see where I'm going with this? Weather is much like the markets, but we'll get there in a second. So if I were to write all of these down, what would happen is I would write all these numbers down, and in the middle, in the big parts in the middle, would be, a relative average, a lot of them. Maybe it would be in the 60s to 70s range, over a given year. And then there'd be a few months in August where, it gets really, really hot. So it'd be 95 or 100. And oh my goodness, we had one that was 101. And then a few months in the winter, it got really cold. It was 25, and one day it got to 8. I can't believe it. The wind chill was 8 degrees, whatever it may be. Okay, so I chart all these, right? I'm able to do that and come up with an average. Now, according to the worldwide Google search, the average temperature on a given year in the state of Kentucky is 58.5 degrees. 58.5 degrees. So, if I were to chart all these down, add them up, divide by 365, I have gotten the 58.5. So, I'm going to put that right in the middle. This is the 58.5. This is the average. Remember, all the data in here makes up all the different degrees and the temperatures that we have. But the average is 58.5. Now, here's what's interesting. Let's assume that I did the calculation, which I'm not going to take you through. I will spare you going through the calculation of how to come up with what we call the standard deviation, which means how much on average is this different than 58.5? Meaning, on average, how high do we go? How low do we go? Well, when you go into statistics and you create this bell curve, we know, this is what standard deviation tells us, that 34.1% of the time, we are going to be one standard deviation above the average, and 34.1% of the time, we are going to be one standard deviation below. Now, this is a universal math principle. So this isn't me, I didn't say, let's just come up with 34.1 because it's weather. No, this is how standard deviation is calculated. It is going to calculate one standard deviation is always going to be 68.2% of the time. Okay? So do you know where I'm going with this? Here's where I'm going with this. Oops, let's go back. Where I'm going with this is, if on average, the temperature in the state of Kentucky is 58.5 degrees, well, 34% of the time, we are going to be anywhere between, we got to add the 22.5, 1, 1, 1, 6, 81 degrees, that's an 8, believe it or not, 81 degrees on the high side, right? And then we have to take the 58.5 and we have to minus 22.5, 0, 6, 3, and 36 degrees on the low side. Does that make, you think about common sense. Think about if you live in the state of Kentucky, and I said to you, you know what? 2/3 of the year, we are going to be anywhere from 36 degrees up to 81 degrees. And you might think, boy, that seems like a big range, 2/3 of the year. But you think, well, that might encompass, some of the cooler weathers in November and December, and, obviously the summer months. And yeah, that sounds about right. Now, you might do something like this in Scottsdale, and you may do all this data, and you may see that over 365 days a year, the Scottsdale weather, literally 365 days of the year, goes from 65 to 75. So your average might be 70, your standard deviation might be 2 degrees, okay? Which tells us that 68% of the time, we might be between 68 and 72, right? I'm going to get some better markers here, which I'm going to do, no problem. And you might say, you might have affiliation, or you might be familiar with Scottsdale, and you go, yeah, that makes sense. I get that. I know the Scottsdale weather. Now, we understand this when it comes to weather, but guess what? This can also apply to markets. Now, that's only 68. I don't have a marker that works here. Let's see. That's only 68, there we go, % of the time. What the rest of the time. Because in a year, 365 days, that's 100%, and I only did 68. Well, that's where statistics come in. And statistics go 2 and 3 standard deviations out from there. So let's go back to the graph. We have an additional 13.6 on either side, right here, that says 2 standard deviations could potentially occur. So what's 13.6 plus 13.6? Let me erase some of these things here. And I'm going to bear with me. You got to stay with me here. I know this is tough. I might have lost some of you already, but I really want you to understand this. This is so very important. So 13.6 times 2 is 27.2 plus the 68.2, which we are already putting in the middle, which means 81.8. Oh, wait, that's not right. 27.2 plus 68.2 is 95.4. What did I just calculate? This is very important. I just calculated that 95% of the time, we will be anywhere between 1 and 2 standard deviations. Well, what do you mean, Quint? That doesn't make any sense to me. Well, remember how we calculated the degrees, 81 to 36. But on occasion, really rare, 13.6 of the time, the 81 degrees plus another standard deviation will actually get to 106.5. 106.5 degrees, 13.6% of the time. You might think, Quint, that's crazy. Well, think about it. That's 4 days a year. Maybe that happens. I don't know. But the reality is it's possible. It's possible because it was recorded. On the flip side, we had 36 over here. We subtract another standard deviation, and we come up with 13.5 degrees. So all of a sudden, what did we just calculate? We just calculated that 95% of the time, all right, 95% of the time, now we know that we could very well be to 13.5 degrees all the way up to 106.5. Now, what am I doing here? What am I doing? I am trying to calculate what I can expect. What I can expect. Now, why would I care? Well, when it comes to weather, it'd be nice if you were moving into an area and you could expect, the median temperature is 58.5. You might go, well, that sounds nice, but holy cow, look at the variance, look at the difference, that the highs and the lows over that time. I mean, if you live in the state of Kentucky, sometimes we hit that stuff every day, right? We start winter in the morning, we're summer by the afternoon, and we're fall by the evening. I mean, the weather patterns are crazy, but that's what our state is. It's just as simple as that. But what we're doing is we're gaining an understanding of the expectation. So this is important, so that when it occurs, we know that A, it's potentially possible, right? We've said 13.6% of the time we could be in the hundreds. That's not out of the question. And oh, by the way, 1% of the time, really rare instances, we could be well over that. We could be another standard deviation. You know where I'm going with this. This helps us to start understanding data sets so that we can understand what to expect. So that, finally, and I'm going to give you an example here in a second, so that when markets, you transition to markets, so that when markets shift out onto a pendulum way over here, like we saw in COVID, instead of going, the world's over, I'm done, I'm out, hit eject, I'm done, I don't want anything anymore, et cetera, et cetera. Objectively, we look at this and go, you know what? Every once in a while, this happens. 1% of the time, this happens. But it's so rare that more often than not, 98% of the time, we will come back to the average. And so that you can start to condition yourself to go, this is a rare occurrence. Maybe instead of hitting the eject button, maybe there's an opportunity here. You see, my opinion, after doing this business, being an investor for over 20 years now, my opinion is people are not inherently poor investors. They're poorly educated about investing. I am a firm believer that if people became more educated about investing and not what stock to buy, that's not, many people think, oh, I need to learn what stock to buy. No, because you can buy the S&P 500, you can buy an index fund, you can diversify in a nice allocation like we do, and you can understand, but it's more about the expectations, understanding what's possible. So let's revert back into markets, and let's talk about from a market perspective then, not the weather. The weather was the example so that you could get your mind around it. Now we're going to take a look at the stock market and how standard deviation and expectations fall in to understanding what markets can do over time. What we're looking at here on this chart is a frequency of distribution. That's a fancy term for basically charting or plotting all of the returns in any given year from 1926 through 2018. Now you'll notice the year is in here, 2016, 2014, 2012. That's fine, but you'll notice that the percentage is down here. So what have we already started to create by plotting this? We have already started to create a big bell curve, just like we saw on the previous example. And so what happens is you can glance at this and you can say, wow, in 1931, the stock market, large company stocks, so that would be the S&P 500, large company stocks, declined anywhere from 40 to 50%. Wow, that's unbelievable, crazy decline, but it happened. It happened in 1 year from 1931. And again, look at this, 1930. Oh, that was a terrible year as well, mid-20s. But look at this, 1933. Something happened in 1933 where the market was up between 50 and 60%. Obviously, you know what happened. This is around the time of the Depression. And these are the early sample sets. And as time goes on, we see that we have this median that has been created. And all what we would do here, and I'm again going to spare you the math of doing all this, but all we would do is add all of these up, divide by the number of periods to come up with an average. Then we would go through the whole calculation that we've talked about to create the standard deviation, or remember, the movement around the average. So let's take a look at that, because it's already been done for you. The large company stocks, the same thing we're looking at here, right? This is the large. I'm not worried about this other stuff right now. In fact, we could come back to that. But the large company stocks through this time period had an average return of 11.9. So all they did here, just to, again to reiterate, that's the sign for sum. We're going to stay in the math class. They added up all the periods here. They divided by the number of periods, and they came up with an average, okay? That's all they did. And that average is 11.9. However, they took it one step further, and they came up with the standard deviation over this time period. This is factual data. This is actually out of the textbook that I teach on, 19.8%. Remember what that means. That means that one standard deviation, and I'll show you this on another chart, but can be anywhere from 31.7% on the high side to, what's 11? I'm going to go to the calculator here so I don't have to do it longhand, to 18, that's not right, 11.9 minus 19.8 minus 7.9 on the downside. So one standard deviation can move anywhere from 7.9 on the downside to 31.7 on the upside. Let's take a look at that. Here it is. This is that same chart we did on the last side, and it has already added up the standard deviations to the right and to the left for ease of function. So let's take a look. 68% of the time, one standard deviation in large company stocks will be as low as 7.9 to as high as 31.7 with an average of 11.9. Every once in a while, how often? Well, we've talked about this, over 13% on either side. We're going to see two standard deviations, which could be as high as 50%. That's nice, right? We like those upsides. Or as low as 27.7. But what about the horrible events? The less than 1% times that we see terrible events occur, like COVID, like the financial crisis, like the Great Depression, like the 1987 stock market crash, like the bank run of the 1900s, on and on and on again, which, oh, by the way, happens about 1% of the time. We could see an astronomical return on the upside, but also a terrible return on the downside. This is factual. This is not a hypothetical weather example. This is actual data taken throughout history. I purposefully included the Depression because I get a lot of people that say, well, we're going back to the Depression. Well, let's include the data set then. Let's include those numbers. So this is a factual data set looking at the S&P 500 to determine how high and how low it can go over a period of time and the probabilities of that happening. Here's the deal, okay? Why am I telling you all this? Because someone who is 65 years old with a 1 in 2 chance of living to 90 has 25 years of an investment time horizon, okay? If we were to break this down just based on the numbers, that means you have a 13% chance, okay, which means about 3 years, a situation where you might see a decline of 27.7%, okay? 13% of the time. So somewhere along your journey, you could absolutely, and probably, I would say will, see another scenario where we move 2 to 3 standard deviations on the downside. On the downside. Now, that also means you might see it on the upside, and you probably will. But it's understanding the expectations. And remember, it's not just saying, well, then I can't do that. Well, if that's the sort of result of understanding this, which it might be for some, then maybe the financial or retirement plan has to change. Maybe you might say, there's no way I can afford to, I can't watch my account go down that much, which we're going to talk about in just a second. Well, then maybe the inputs have to change, and maybe the plan has to accommodate the fact that you're not going to get the return that the market's going to yield, but you're going to get a lesser return, whatever the case may be. But remember, this is 100% stocks. So let's go back and talk a little bit more about allocation. Because remember, what we're talking about here is if you were fully invested in stocks, and hopefully that's not the case. Why? Because your goals may not mandate you having to achieve 11.9% return. Hopefully they don't, because that would mean you'd have to be fully invested your entire investment time horizon. That's going to be very difficult. the older you get, age-based allocation. Or maybe your temperament is such that you just don't have desire to see the fluctuations, whatever it may be. But the reality is, what's very important, this is the crux of it all. I really want you to understand this, especially coming off of years that we've had really, really positive and strong markets. And some of you might just be going out into the workforce and you're starting to invest. And what I don't want to see happen, I don't want to see you go through a decline and then back away and say, oh, that's just a big casino. I don't want anything to do with that. I'm never going to touch stocks again. That would be tragic. Why would that be tragic? Because what you did is you went through a scenario, which is a decline, that was actually possible. Why? We charted it 13% of the time, 1% of the time, 3 standard deviations. It's going to happen. And instead of going, oh my goodness, I'm never going to do that again. No, you go, boy, it happened. That stinks. I don't like losing money. Nobody likes losing money. But it's a rare occurrence. And instead, I'm either going to stay the course, be perfectly fine, or maybe you're opportunistic like I am sometimes, and you go, you know what? I'm going to be a buyer here. Because what's happening right now, 3 standard deviation move in the market, which we saw in COVID, 3 standard deviation move in the market, this is absolutely unheard of. I'm going to be a buyer instead of seller. And that's where you become opportunistic. Much harder to do in practice than in theory. Everybody says, you know what? Be a buyer when everybody's panicking. Until everybody's panicking. And then you're more worried about stocking up on toilet paper and bread than actually buying stocks. But that's been the best time in the last couple of years during that panic to take advantage of the market. But most people are not educated about it. And it's not just saying buy low, sell high. I hate that. It's not about that. It's understanding what's possible. Let's take a look at a standard 60-40 portfolio and look at what would happen then in regards to the dollar amounts. And let's assume someone has a standard 60-40 portfolio, 60% in stocks, 40% in bonds. Now let's also make an assumption that this total portfolio is $500,000. Now I know what you're thinking. $500,000 to those of you that are starting to enter the work world, that's a lot of money. Wouldn't that be nice? But there's some other that's a lot of money too, and others that it's not. But let's use this as an example. It's all relative. $500,000 with a 60% stock exposure means that there is $300,000 at risk in stocks. Now, here's the same chart we just looked at on the previous slide. And what we're going to do is we're going to equate the actual dollar amount lost on the portfolio when we see these normal events occur. This is what is critical, in my opinion, for people to understand. I'm not worried about the gain side. It's wonderful to make money. I'm talking about the loss side. Now, 1 standard deviation move in stocks would mean we could have a low of 7.9. Well, if you were only 60% invested, your loss would be 4.74%, or a loss of $23,500. Now, most people, look, nobody likes to lose money, but $23,500 on a $500,000 portfolio, it's palatable. It might hurt a little bit, sting a little bit, but here's the deal. 68% of the time, we know that our loss could be $23,500, but that's only 68% of the time. What about the other 13 and 1% of the time, right? What about the other percentages of time where we have more than 1 standard deviation? Well, 68% of the time, we've lost 23. How about 2? Well, the 2 standard deviation, you wouldn't lose the 27.7. You would lose 16.62%. That equates to an $83,100 loss. That is obviously a lot more painful. Is it something that you could withstand? Can you know that 13% of the time, that is a possibility? If you have 30-year time horizon, you're looking at 3 to 4 times that's going to happen in your 30 years. That's once every decade. Are you going to be okay seeing your portfolio decline $83,100? How about the 3 standard deviation, the very rare 3 standard deviation move where we see a significant decline? Well, it wouldn't be 47.5 for you because you only have 60% invested, but it would be 28.5% for a total loss of $142,500. And you might see that number and go, Quint, absolutely not, no way. Well, newsflash, if you're 60% invested and we have a 3 standard deviation event, which could occur a certain percentage period of time, that is what you are looking at seeing the portfolio decline. Except you have to know that the event is so rare that when it occurs, more often than not, we are going to move back into the average over time. And as we saw back here, when those events occur, they're often accompanied by events that swing the pendulum to the other side, where the upside is just as great. But again, it's not about whether or not it may occur, it will occur. And the question is, can you stomach the decline in the portfolio? Are you okay with that risk? Here's a look at a breakdown of, this is directly from our office, what the average annual return and the standard deviation is for various model portfolios that we have. The equity of a 90-10 portfolio has had an average return of around 7.7 for a standard deviation of 14.8. Equity fixed 70-30, 6.5, 11.7, and 50-50, 5.1 with a standard deviation of 8.8. What does this tell us? Again, what you would do is you would write these numbers down and you would look at 1 standard deviation, 2 standard deviation, and 3 standard deviations to know what is possible around the average. That is key. Now, what do we do? All right, we've got this information, and hopefully, here's the tragedy. It would be an absolute tragedy if you left this presentation and just said, well, I liked what he was talking about, but I have no idea what he's talking about. That's inexcusable. You can't do that. That doesn't work for me. What you have to do is embrace, and if you have dollars invested in a market, if you have an IRA, if you're starting an investment account, and I don't care if you're a kid and you're on Robinhood and you're on your app, if you are investing in the stock market, if you do not understand and comprehend risk, the risk that you're taking in the markets, the risk that portfolios are going through, then you are gambling, and that is not sound investing. Investing soundly with principles, solid allocation, that you are understanding risk and that you have a plan, that sets you up for great success. Anything else, gambling. And you are going to go through one of these events and you will be bit. Maybe you already have. Maybe this has already happened to people. I see this all the time. So I say, well, I got out at this point in time and I never got back in. Why was that? Why did you do that? You did that because you didn't realize that was possible. You didn't realize that that was going to occur sometime in your life. Many people don't realize how often that can occur. If you have a 30-year time horizon, odds are you will see a 2 standard deviation 3 times in your lifetime. That's once every decade. So once every decade, we could see a significant decline in the markets. Simple as it's what's happened. Does that stop the economy? Do we just be thrust back into the Stone Ages? No. It's a capitalist society. Businesses figure it out. Entrepreneurs thrive. We have a great structure in our country, and they continue to thrive, and new businesses arrive on the scene, and they replace. We're sending guys to orbit right now. I mean, literally, as I speak, we have launched a shuttle, a consumer-based shuttle into space to orbit the Earth. We are seeing amazing things in our world. But nonetheless, what would be definitely a shame is if you got bit by this and said, game over, I don't want anything to do with it. You would then miss out on all of the amazing opportunities once you understand and have the expectations of what really can happen. So, number one, what is your allocation and portfolio volatility? You have to know this. You have to know what the expectations are. And if you don't know this, you should be learning this very quickly. So you should be looking in and saying, okay, what is my allocation and what is the movement that I can expect within this allocation? So that when it occurs, you know that you're comfortable because it's within the allocation. It's within what the expectations are. However, if it's something that you cannot stomach, you do the numbers and you go, look, this is too much. This is why I wanted to do this video in this environment, because we've been in such a positive environment such a long time, that if you run those numbers and you calculate that and you go, I can't withstand, then something has to change. And that's okay, but something has to change. What does it mean in dollar terms? This must be calculated, in my opinion. It's nothing to say, oh, well, you could expect a 12% decline at any point in time in the portfolio. Oh, okay, 12%. That doesn't sound very fun. No, but what if you have $1 million? Are you okay watching it go down $120,000? Because that's what 12% is. In my opinion, you have to equate this to dollar terms. You have to embrace it. You have to understand it. Number three, does your allocation equal your goals, equal your risk tolerance, equal your temperament? As I talked about in the beginning, this is all ingredients into the overall calculation. You cannot just look at one as in isolation. You cannot just say, oh, I'm 70, so my allocation should be this. No, what if you're spending X? What if your medical expenses continue to rise by 6%, inflation at 3%, 4%, 5%? Are you able to keep up with inflation? It doesn't matter. It doesn't matter what your allocation should be based on age if it's not keeping up with inflation, the number one reason why we invest. So it all has to be taken into consideration. Why? What do? You have a plan. Again, I don't care your age. I don't care if you're listening to this, you're in one of my classes and you're just getting out, you're just getting started in your 401k or your 403b. What is the plan? What is the objective? As you start to invest, as you start to formulate your long-term investment plan, you have to take in consideration what the goals are, what the objectives are, what are the goals to achieve, and what is the allocation that's going to get you there, and are you okay with the risk? I hope you've enjoyed this presentation. I know it's a lot. I know that we have a lot going on, and that's okay. Go back, listen to it again. I talked about a lot of heavy subject matter, standard deviation, all of the calculations, but it's so critical to understand what exactly is going on in the markets, what the expectations are, and so that you can not only go through the ebbs and flows of markets, but you will eventually learn to take advantage of the opportunities that present themselves. I really appreciate your attention. If you have any questions, you can reach out to me at any time. Make it a great day.